is your approach fundamentally different when you're looking at a small cap space?
You would have heard this phrase that small cap is all about bottom up approach, right? For me, it is totally top down. 70 or 80% of the work is done if you identify the right sector to invest in. Chemical was a booming sector in India. I would say even the worst management within that sector led to 20x growth in the market cap, and the best led to 100x. Even if you go wrong,
Many a times these guys are available at very high P's. How do you balance between the growth and the value of small cap stock?
so I always joke with my colleagues that it's actually not P price to earning ratio, but it's a perception of growth. If you perceive the company in a very, very high way, you end up paying.
Hello and welcome to Ventura Spotlight, a podcast series that brings you thoughtful conversations with the minds shaping India's investment landscape, exploring their philosophies, experiences, and the lessons they have gathered along the way. In this episode, we are pleased to have with us Tejas Sheth, Equity Fund Manager at Axis Mutual Fund. Tejas holds a PGDM in finance from TFI Management Institute, Manipal. With over 2 decades of experience in equity research and fund management, he currently manages the Axis Small Cap Fund with an AUM of over 26,500 crores. So let's get started. Hello Tejas and welcome to Ventura Spotlight.
Thanks for having me.
Before we get into the entire, the journey and what you have been doing, so can you tell us how you started into this, the field of equity and what made you get into the fund management activity?
On a brief background, I come from a Gujarati family. My father was into a textile machinery parts business, but always into as a hobby, or I would say as an interest, would invest in stock market. And even my cousins, my uncles, would be about active investors in stock market. And somehow that kind of always fascinated me at an early age. In fact, since 12th standard, I always wanted to be into managing people's money or investing in stock market actively. In fact, I also participated in a lot of inter-college events which were part of stock market. So it was always an area of interest. One of those few lucky guys who ended up into something which I always loved doing. So yeah, that's the brief in a way that how I kind of got into investing world.
Yeah, I think very interesting, and I think helps being coming from a family which always, looks at stock market as an investing, and
Yeah.
I'm sure Gujaratis are the pioneers of the stock market in any case.
Exactly. I mean, it would not be a single family, I think Gujarati family, which would not be investing in stock market. I think somehow directly or indirectly, we are connected to stock market world. And so that has been the environment and culture, I would say, at the family level.
So since you have, started also at a very early age, I'm sure you would have had very early lessons also in the stock market, and so what, if you can share a few of your learnings and what fundamentally how you started approaching the fund management, since you said that you were also interested from your 12th standard onwards and you always wanted to be into some sort of a fund management. So how has it shaped you fundamentally over the last 2 decades of what you're managing now?
Yeah, so I think one thing is that I've worked across the part of the industry, be it at the family office or on the sell side, and now obviously on the mutual fund buy side. So it has added a lot of dimensions to my understanding of stock market. But one key thing which I believe is in identifying multi-baggers, or I would rather say wealth creators, are the companies which kind of always think of very, very long term in terms of what they want to do. If you see, any company will always has its limitations in terms of having a very quality growth, because eventually some competition or the sector cycle will start impacting their growth. What I have seen is that the most wealth creators are the companies which eventually start thinking beyond their core business, and they start adding newer and newer avenues of growth, either in terms of geography or in terms of new segments which they want to enter, or in terms of agencies to their current offerings. So my always endeavor is to find those management which kind of think beyond their core business, without obviously compromising on the financial matrix, but something which can last much longer than the current uh, business cycle or current boom in the stock market. So is always one thing which I keep looking for, and I've learned this over last 20 years. Is it's difficult to identify these names because there are very few in the market. But once they do, there only that one success story can take your fund or your investment portfolio to newer heights.
And Tejas, since you are, handling the small cap space, which is a very, very interesting space per se, and it requires maybe a different approach, or I don't know, in terms of, that's what we want to understand from you. So is your approach fundamentally different? When you're looking at a small cap space, how do you approach that particular segment, because it has a lot of volatility, lot of risk associated, too many things to be looked at. So how do you manage that part of the activity?
I think when it comes to small caps, you would have heard this phrase that small cap is all about bottom up approach, right? For me, it is totally top down. I mean, um, the larger part of my analysis goes towards identifying sectors which will do well, and once that work is done, is then the next stage is to identify small caps within those sectors. Why I do say this is because a small company will never be able to grow or thrive bigger if the sector tailwind is not in its favor. Um, I mean, if you see all the small caps which have become mid cap or even large cap, for where are very few of them, are the names where the sector tailwind has been good and the management capability to understand that opportunity and capitalize on that. So these two factors are very, very important, and hence for me always it's about top down approach rather than bottom up approach. And there are n number of examples we have in last 10 years, 20 years, where even the worst small cap company has done phenomenally well in a sector which is growing or has a huge scalability and growth opportunity. So I think 70 or 80% of the work is done if you identify the right sector to invest in.
That's a very interesting approach. I'm first time understanding that if you get the sector right,
Yeah.
and you're most likely to get even the company right in that.
Yeah, I can give you a good example. From 2015 to 2022, chemical was a booming sector in India. I mean, because of the China shutdown and various external factors. Chemical is not new to India. It's been there for 25, 30 years. But those 7 years, I would say even the worst management within that sector led to 20x growth in the market cap. And the best management led to 100x.
Wow.
So I'm just saying that even if the management, a bad management in that sector had not done any active business strategy, they still ended up making 20x money for their investors.
That's very interesting.
Yeah. So it is very critical to identify the right sector, and even if you go wrong within that sector and identify the uh, right company, you still end up making a lot of money for your investors.
Yeah, and what you're saying is absolutely correct, because I also remember, that yes, the chemical industry had a very good boom during that phase when you mentioned that. And there were certain names where I said, this is not the company to look at, and suddenly somebody comes and tells me, but it has gone up so much. I said, how did it happen?
True.
So what you said is right, that even
True.
a bad company actually tended to do well
Yeah,
out
yeah,
there. Right?
yeah.
So now when you come to that, identifying a good sector, identifying, getting it right, right. So what are the non-negotiables that you would look at in a small cap, that okay, these are things which are very, very important, because you know uh, a bad management company, you said, can also do well, but there is a possibility that you may not want to look at it.
Yeah.
So, what would be your non-negotiables? When you're looking at a small cap stock.
So two factors very much which I really follow to the T is one, the scalability of the business, and second is the capability of the management. Okay, scalability of the business, as I said, the sector needs to have a huge scalability. Like let's say agri input sector in India doesn't have a huge scalability, despite it India being a very agri driven economy. The scalability of crop protection in India is not very high. The agri inputs industry usually grows by 5-6%, right? So even if a good management operates in that sector, they will not able to grow more than 8-9%, right? So scalability of the business comes first for me. And second, within that scalability is the management's capability. And when I say management capability, is just not how the promoter thinks, but also how the tier two management within that company has been placed to drive on that opportunity with the scale, with the sector scalability provides. So I've seen, as I said, two factors which will make a small cap become even a mid cap or a large cap. But any of these two factors are missing, okay, the small cap will remain small cap.
Okay. So scalability and capability
Yeah.
are very important.
Very important.
Okay, excellent. So and we also keep on talking about corporate governance, and I think and that has become a key factor nowadays. Everyone talks that we have to invest in good management companies. But how does one identify a good management? What would be your characteristics to identify a good management?
So identify a good management, or let's say even a good company. Again, I would say comes in very subjective way, or it comes in a objective way. The subjective way is how you have been interacting with that management in, let's say, over the years, and whenever they have guided for any growth or any event, have they really achieved that, right? Because a lot of management do misguide because they are so market cap focused that they do misguide the investors. So the subjectivity comes from them, that whether they have executed or what they have promised to the investors, and do they have a really good talent to execute the whole business strategy. A single man who's not able to delegate work will always remain in a very small thought process. So very important, even if it's a promoter driven company, the promoter needs to understand that he's limited by a certain bandwidth, and hence if he wants to grow, he needs to have a lot of strong tier 2 management. The second, objectively, how you look at a good governed company is through numbers. I mean, numbers speaks louder than the words, and eventually start looking that, is this company generating operating cash flow? Is this company focusing on return ratios? Is this company having a not so much leverage? What is the capital allocation strategy of this company? So objectively, you can obviously catch them on numbers. Subjectively, as I said, that it's very soft skills of those promoters in terms of how they disclose the numbers, how they disclose their thought process, rather than saying something and doing something.
Good, interesting.
And because we have seen management who kind of promise you very high growth, and within 1 month they come to sell their stake in the company.
Right.
Right. So all these soft skills are very important. That if you are really promising something, then why are you exiting or reducing your stake in that particular holding? So these soft skills kind of matter a lot. I mean, in understanding the management thought process.
Okay. So even for small caps, there's always going to be a challenge, between when you have to find that where, because sometimes the P's are very high, or so valuation and growth. Means how do you balance between that? Because you are looking at a value pick, because in small cap you have to have a deep value for you to put in your stake over there. But many a times these guys are available at a very high P's. So how do you balance between the growth and the value of in a small cap stock?
So I always joke with my colleagues that PER, which we say is a P ratio, price to earning ratio, is actually not P price to earning ratio, but it's a perception, a short form of perception of growth or of the company, right? If you perceive the company in a very, very high way, you end up paying higher P. And if you perceive in a lower way, you end up paying lower P. And that perception typically comes from two factors, is the management quality and the growth of the company. A lot of people say that growth visibility is where the valuation falls. I think rather than growth visibility is the growth certainty. Why I do say that is growth visibility at times comes from a good order book. Let's say a company having a very good order book, you are certain that there's a visibility of a good order or revenue booking coming up. But growth certainty is not something which that order gets into execution without getting compromised on the margins and working capital, right? You may end up having a good order book which shows a visibility of growth,
Correct.
but what is the quality of that growth is very, very important. And we have again seen in multiple sectors, you literally have a strong visibility of growth, but the quality of growth deteriorates as you keep growing at a higher rate. And that's where the P factor comes into play. At the fund level, what we do is we always build hypotheses on certain companies, right? We keep checking that hypothesis and we start questioning that hypothesis at periodic intervals, that what we thought at the time of investing and what it is there today, is there a stark difference? There could be cycles within the long term cycles. There could be small ups and downs in the business, a quarter or two. But if that hypothesis gets questioned on the long term growth story side, we either exit that company or we try to lower the weightage of that company and hence lower the risk at the portfolio level. So, as I said, valuation is a perception of the growth. And hence, I would rather pay higher value for a higher growth company because I think that will still generate returns for the investors, but not get stuck in a lower P, lower growth company because it's a value trap, right? So, given a choice, I would still pay higher P for higher growth company and remain invested in that. If and not invest in a lower P company because that lower P is typically for a reason, and it could end up being a value trap.
Oh, okay. Interesting. So actually now P we should call it as the perceived earning
Yeah, exactly.
rather than the price earning.
Yeah.
So that leads me to a thing that and so obviously in small cap we all expect volatility. We have seen that I think this year, we have seen it last year that it's whether it's on the upside or it's on the downside. It's never a moderation. It is
Yeah.
always at the extreme ends, right?
Yes.
So how do you manage the volatility, because you are seeing it day in and day out, the prices are going crazily up or crazily down. So how do you manage your perceived earning in that
In
sense
that sense.
when there is volatility in the stock?
I think volatility is part of the business, right, or part of investing world. A larger part of volatility I try to cut down at the fund casing level. So we don't take any extreme calls on 3 C's of investing. We don't take extreme calls on concentration. We don't take extreme calls on cash levels in the company. And we don't take extreme calls on the how the company actually behaves in the downturns, right? So very important that extreme calls at the fund level, at least at the mutual fund level, is not what investor is paying you for. If they wanted a very concentrated portfolio approach, they would might as well invest in PMS, right? And with that kind of thought process, we try to case the fund in a perspective where the extreme volatility gets captured in some form or the other. Why I say this is we don't invest in a very expensive company also without low growth visibility, as well as we try to balance the portfolio with a some cyclical low P value growth names also in the fund level, right? Because investing is all about managing risk adjusted return. Yeah, if you want a very high return, then you'll always have to take higher risk,
Correct.
right? I mean, if anyone says that you're going to generate higher return without taking higher risk, it could be very, very short term driven. But over the long term, the risk will follow return. And hence, um, at the fund level, we try to balance that. We don't take, as I said, a very extreme value growth story approach, or we don't take a extreme call on the high multiple, high growth, high valuation driven approach as well. We try to balance it somewhere in terms of valuations, in terms of sectors, and in terms of management quality as well. So it's very important to have a mix of it, which kind of actually reduces the volatility at the fund level.
So again, what has happened is that I'm sure you would have also witnessed that now the whole small cap landscape has undergone a change. Right? I mean, what was the 5 years back and today, the whole the valuations are at a different levels from what they were before.
Yeah.
So what, according to you, the investor should look at in terms of these structural changes which have happened, because you are bound by the AMFI definition of market capitalization.
Yeah.
That, so now a small cap company starts only at 30,000 crores,
Exactly.
right?
True.
And obviously you have a longer tail where you can go down to. So, in your view, how should the investors perceive this new change in the structure which has happened?
I think investor doesn't have to really focus on how it behaves, because with the size of the market cap going up, the economy size also has increased, right? You have to see in those parlance. A lot of people tell me that the AUM of small caps have increased so much. How easy or difficult it is for you to manage. I said with the AUM, the market cap also has increased, right, collectively, and also that is driven by the GDP. Typically, the market cap of the whole investor world is in a good market will be at 1.2, 1.3x the GDP. So if your GDP is going to grow, the market caps are going to grow, and hence it's not difficult to find investing in small caps today. For the investors, they have to think in those lenses that small cap, being a small cap, obviously by AMFI definition, it is anything below 250th market cap company in terms of size is a small cap, and those companies still can have a very high growth opportunity, right? Because the economic growth is so phenomenal, and hence we always tell them that with the small cap becoming, let's say, sizable in nature, it also brings a lot of governance at the small company level, because a lot of people say that small companies are not well governed, but with size becoming bigger, I mean, end up becoming a well governed company, well managed company, a company which can go global, which can enter into exports. So that's how I think the structure of the whole small cap has changed. I would say uh, it is a better way of investing in small caps rather than investing in below 1,000, 2,000 crore market cap company, where there are a lot of ifs and buts. The access to the capital is not very easy, and it's not well governed or well audited companies. So when you're investing in a 30,000 crore company, also it can still has an opportunity to become 50,000, 60,000 crore
Correct.
market cap company.
So, in fact, yeah, that gets me to your question when you talked about that. The size of the economy, market cap, everything has increased, and so you are also managing a fairly large small cap fund, right? So, how do you manage? Do you see that any risk in terms of that? Would you stop after a particular amount that there is not investment opportunities available? How do you see that at nearly around 26,000 odd crores? where you stand. Because SEBI has also introduced that you have to have the liquidity norm
Yeah.
in terms of in small cap fund.
Yeah.
So how do you see that? Because I also personally feel that that now small caps are not that riskier what they were 5 years back, because the size have increased,
Increase.
and with the size the companies also tend to become more conscious.
Exactly.
So how do you see that?
So I think fund size is just a mindset. I don't think it is a hurdle. As I said, because of the fund size becoming bigger, even the universe of small cap has become bigger. There are at least 600 companies within 3,000 crore to 30,000 crore market cap.
Correct.
And most of the IPOs which are coming in the market are in the small cap space. So, right, the universe is kind of expanding. In fact, small cap investing is so exciting today because all the emerging sectors which are getting added in the small caps, be it on the CDMO side, electronic manufacturing side, precision engineering side. These sectors were not present in 5 years or 10 years ago. And these are the emerging sectors in India, right? And it provides us strong opportunity for the investors to participate in these sectors through small caps. So, at the fund size of 26,000 crore, also, I don't think it becomes very detrimental for me to invest in small caps. The overall, when I put overall market cap of small caps in India, it's 40 trillion rupees, 40 lakh crores. Okay. I'm just 26,000 crores. Even if I take the free float at broadly 50%, I still have a huge canvas to invest. So it is not detrimental. Liquidity can be a issue at times because everyone chases the same small caps or chases the same growth story. So there, the endeavor always lies to identify the sectors before the street does, right? One, it will give you a lot of liquidity. Second, you can have a lower impact cost. And third, obviously, the most important is that you can generate larger return for investors if you identify the stories much ahead of the industry identifies. So my forte, as I said, lies only in that identify the sectors which will do well over next 5-10 years, and then once that sector identification is done, finding the company within that sector becomes much easier.
So would it be right to say that investing in a small cap fund is now less riskier than what it was 5 years back?
I would definitely say that one, it will be less riskier, and second, it will throw much many opportunities
Yeah.
in terms of participating in some of the sectors which have no or very less presence in mid caps and large caps. So I would definitely say that in a emerging economy like India with a high growth, it is always better to participate in emerging sectors, and the best way to participate is through small caps.
And I think what you're saying is right, that we are having so many IPOs, and most of the IPOs which are coming are first getting added more into the small cap space.
Yes.
So it's adding not only new companies but new sectors,
Yeah.
and that allows you to even participate
Participate.
over there. Yeah,
Yes.
that's a fair point.
Yeah.
So one conundrum which I'm always facing is that the SEBI mandate has that 65% minimum has to be in a small cap stocks, right? At one side we have and you have a benchmark. Hmm. The benchmark is of between 251 to 500.
Yeah.
That is a benchmark,
Yeah.
right? Now, what we have also seen is that and I'm taking on an industry aggregate, where your fund could be a little bit different over there, is that on an average you find around 70 to 72% of the amount is invested in small cap stocks. The remaining portion is either more into mid cap or large cap, either to manage liquidity or whatever manner, right? Now, when you are comparing the benchmark at one side to a small cap where only 72% gets invested, and that also sometimes some stocks are even beyond 500.
Yeah.
Is it a right approach to look at from an investor point of view, that you are, to generate alpha, right? Because one of the period, I think it was 23 or 24, the benchmark was something like around 49%, and the average was around 39%, right? Now, do you say it's a bad return, right? Because
Got it. Yeah.
39% is a very good return,
Yeah.
right? But somebody can turn around and say you have not beaten the benchmark,
True.
right?
True.
So how would it make you feel as a fund manager, where you say
Yeah.
that you have performed,
Yeah.
but now is the benchmark actually a comparable benchmark?
I think it is a comparable benchmark. I mean, and if that is something given to you, it is something which needs to be followed. Otherwise, you are never going to be able to judge that whether this fund or that fund has done better or worse. Absolute return obviously has its importance, but relative return versus the benchmark is the key, right? Because if someone is paying you more money versus investing in ETF, might as well they expect a higher return from you. And hence the benchmark becomes a key in terms of understanding that whether the fund is doing well or not. To your previous part of this same question is, will it be a right strategy to remain invested at around 70% of your fund at small caps and the balance in mid cap and large cap? I would say as long as you're beating the benchmark, it is a right strategy. If you feel that small cap is going to underperform versus large caps in the near term, and if you tactically try to play that strategy by investing more towards a large cap, I would say relatively more. Obviously, you cannot go beyond certain percentage and try to generate alpha for your investors. I don't think it is a wrong strategy. But yeah, if you feel that the small cap index per se is going to outperform large cap or mid cap, that's the call obviously you have to take as a fund manager. Because and then if you remain invested in large cap or even in for that matter in cash, and then the investors is going to suffer. That's why I said I don't take very extreme calls. One, on the concentration side, because it drives down a huge concentration risk at the fund level. Second, we don't take very extreme cash calls. I mean, you would have seen a lot of small caps take extreme cash calls of 15%, 20% of the fund being in cash. We don't take that. We have tactically taken cash calls, and as soon as we feel that the market is going to turn, we have deployed that. So it's very important to be nimble, to not have very rigid outlook, and understand that what mandate you are running for your investors.
So one more thing is that for a small cap, you require to do maybe a little bit much more deeper research, because not too much data is also available in public domain. It is more need to fundamentally dig deeper. So that is one side of it. Secondly, it can also be, emotionally very stressful
Yeah.
when you see price movement going haywire. The company may be still on its path track, but
Sure.
price is, whatever it dictates in the market, and that's what you see every day. You don't see the fundamentals change every day
Yeah.
in that sense. So how do you deal with that type of a situation?
I think emotional intelligence when it comes to fund management is a derivative of the deep research you do. The second factor of yours is a dependent on the first factor. Why I say that, if you spend a larger part of your work in doing the deep research and you don't bet on your investments through others' conviction, then that emotional intelligence part is taken care by, right? Because you know that what this company is doing over a longer period of time. And as I said earlier, also, there will be small cycles within the larger long-term cycle. Let's say if you have invested in a pure play AC manufacturing brand company, there would be some summers which will not be good for the AC manufacturers. But eventually, over a longer period of time, knowing that how the penetration in AC is in India and with the growing per capita income, this industry will do very well, right? And that's a live example from my top 10 holdings in the fund.
Okay.
We remain invested, right? Because my larger hypothesis on the growth story is not getting questioned. And hence, the emotional intelligence or emotional thought process towards that investment doesn't come into picture because we have done our work. And hence, I said that deep research is very important to tackle your emotional intelligence. Do we still end up doing some mistakes? Obviously, we do, right? And I would give you a good example right now, which I faced this year. I was sitting on cash. I was underweight NBFCs, okay? And the government in February, March time infused huge liquidity in the market. RBI, in a way, infused 9 lakh crores in the market through OMOs. Also had a 50 bips rate cut, which came out of nowhere. People were expecting
Correct.
25 bips. And since I was underweight NBFC, I went, my alpha generation from that sector was negative and it got impacted. My performance got impacted. But if I start thinking that, okay, I cannot react and that deep research factor will remain that, okay, eventually NBFC will under perform, I would have lost a lot of alpha for my investors. And we quickly changed our strategy. We deployed the capital towards NBFC because that was the need of an hour. You cannot have a rigidity towards investing when you're especially doing investing for other people, right? And hence the lost alpha within that short period was recouped over 3-4 months. But if I remained with that rigidity, I think I would have lost much more alpha for my investors.
So being nimble along with deep research.
Being nimble is along with deep research is very, very important. And uh, always understand that your thought process will be challenged, will be questioned, and you should not remain rigid on that. That one learning I've had um, observing a lot of senior fund managers when I was an analyst,
Okay.
and that learning have imbibed in my fund management role also.
So over the years, what are the core investing principles you have adhered to, irrespective of the market cycles? Since so, what are the core things in your as the investing principle you would look at?
One, as I said, never be rigid.
Hmm.
Um, every sector in every economy will have its own cycles. Okay, value is growth is always debated. But if you understand those cycles and try to play through it, I think a lot of work on the alpha side is done. So never have that rigidity towards the thought process or the style of investing. That doesn't mean you compromise on the governance side. What you have to just compromise or become little bit tactical is on the investment style, and ride through those cycles for your investors. So that's one learning I have. I'm very, very sure about what I want to do. Second is to always question your investment, even if it's successful, at every periodic intervals, be it 6 months, 12 months. All your winners, which you have had in the portfolio level, you need to question them that are they still winners? Are they still going to be winners? And hence remain invested or exit or lower the weightage. But we all at times become complacent, right? That
Right.
this stock is doing well, it will keep doing well. And we start questioning ourselves, we start questioning the promoters towards their growth strategy because it's a typical human behavior. So keep questioning. Um, um, Whether they are winners or losers at the portfolio level, you have to keep questioning your hypothesis and your return profile for which you're expecting from that particular investment. Third, as I said, identifying wealth creators is very, very important. And that comes very rarely, but the endeavor should always be towards that.
Okay.
In identifying long-term growth stories, because once that identification is done, your emotional call towards taking decisions also narrows down significantly. So these are the two, three factors which I've learned by observing others, by putting a lot of mind towards fund management,
Okay.
and hopefully, I think they should play out.
Good. So, one last question is there. So, what, since equity fund management can exciting, stressful, everything, emotions are there daily, up and down. So, what personal habits keeps you grounded in this field?
So I don't have any personal routine or habit to, on any given bad day in the market, which obviously I have. Uh, I go for swimming.
Okay.
Okay. I'll tell you why. I think swimming is one activity which helps you to cut noise externally and internally, and you just focus on your technique. And these three factors has such a strong analogy to investing also. Focus on your technique, cut the noise internally, which is your emotional decision making, and cut the noise externally, which is the rumors or
Correct.
event driven noise which comes up. Swimming has taught me that,
Okay.
and I try to implement that in my fund management as well. And I enjoy swimming. So do I enjoy investment management.
Good. We will do a rapid fire.
Sure.
This we do with every fund manager. So,
Sure.
what's harder in investing, finding a good stock or holding it?
Finding the good stock. If you find that, I think you can keep holding it.
Okay. If small caps could talk, what would they complain most?
Expectations, return expectations. I think the way they have generated return in last 4-5 years, the return expectation has gone through the roof.
One number on the balance sheet you trust more than the headlines.
I would say two numbers: operating cash flow and return on incremental capital investment.
One habit investors think is discipline, but is actually impatience.
I think averaging at lower levels
Okay.
and not cutting losses.
Okay. One business trade that immediately earns your attention.
Capital allocation strategy.
The most common mistake investors make while investing in small cap funds.
Not understanding the risk to return profile.
One word that best describes the current small cap market environment.
I would say consolidation.
Oh, okay. So thank you, Tejas. It was very good having you, and I hope you also enjoyed as much as I did.
Yeah. Thanks. I mean, the questions were amazing. I think they're quite thought provoking. Thanks for having me.
Thank you.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully